The Bank Supervision Department says the South African banking sector remains well capitalised. While the sector remained profitable, those gains slipped somewhat. Return on equity, a profit gauge in the banking sector, was 14.74% in the 3 months ended December 2013. That's down from 17.74% in the 3 months ended December 2012. Meanwhile, bank costs rose. Banks' cost-to-income ratio rose to 53.6% in December 2013 compared to 52.8% in December 2012. The higher costs are likely to have weighed on profit outcomes. While the department admits that new regulations, like the implementation of Basel Three last year, will have added costs for banks, it says it's one of many factors that will have caused bank costs to rise.
I don't think there is a direct impact in terms of a decrease in profitability as a result of banks adopting Basel Three. But banks have become, over the last 12 to 18 months, much more selective in terms of the types of business they do, the assets they put on the balance sheet. They've all revised their risk appetites coming out of the global financial crisis.
The Reserve Bank indicated its concern at the lower economic growth number, which shrank by 0.6% in the first quarter, adding that it was all the more reason to supervise the banking system in ensuring that it's able to deal with negative as well as positive environments.
Remember that in 2008, we had an economic contraction of 6.8%. In one of the quarters. We didn't have an adverse impact to financial stability. But that is exactly why you make your financial institutions to build these big capital buffers so that they are able to absorb the shocks when there is a slowdown to economic activity.
Kganyago added that as the economy slows, so too would credit extension, which would minimize banks' exposure during a difficult economic period. Nompumelelo Siziba, SABC News, Johannesburg.